Get Rich Education is brought to you by Norada Real Estate Investments and Mid-South Home Buyers.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 57. I'm your host, Keith Weinhold, and I'm back to help you build your wealth with the show that's educational, actionable, and inspirational. This is the second episode of a series of 3 consecutive shows that I'm doing to help you best understand your mortgage loan. And this week, I'm coming to you from location here in Little Rock, Arkansas. I'm here at Little Rock's Capitol Hotel, which is the same hotel where my wife and I are staying. It's a pretty nice 4-star place right in the heart of downtown here. Someone told me that it's the nicest hotel in town. I'd believe it. It's kind of the historic luxury hotel here. I've been reading about the Capitol Hotel. It opened in the 1870s. President Grant stayed here. It's been used for a lot of political announcements. In fact, this served as President Clinton's local headquarters during his presidential tenure. So yeah, I want to do Little Rock right. It's my first time here, and the reason that I'm here is specifically for a investment real estate tour. My wife and I don't know anyone in Little Rock other than the real estate provider that's giving us a tour tomorrow. And yes, I've come here solely because I like traveling and learning about cash flow producing real estate markets, and I can share this with you if I end up thinking that it's a worthwhile market. I could tell you more about it in the future. The metro statistical area size here is 730,000. So that's smaller than most markets I consider. And in general, I like the larger markets because then you typically have a more diverse economic driver that can provide sustainable rents over time. So I chose Little Rock because it has rent to value ratios that produce cash flow. And as a state capital, I expect to find that there is some stable base of government employment here that we can count on such that tenants can keep paying our rent over time. And some consider Arkansas as the most landlord-friendly state in the nation, where the landlord can begin the eviction process if the tenant is just 1 day late on the rent. So I'm really looking forward to the Little Rock field tour with the provider tomorrow, but don't expect me to feature a Little Rock specific show for you too soon because I like to take my time to kind of vet out potential investments, cross-pollinate my experiences with other investors, and really study things closely here. But maybe I'll do a Little Rock show down the road, depending on what I find for you tomorrow. And then next, we will be in Memphis, where I plan to bring you a full show from Memphis sooner than later. So I like to get out into markets and kind of take their temperature, really see what's going on from the quality of the renovated homes that the provider provides, to the operations of the management company, to the types of industry that are creating jobs for your tenants that create cash flow for you. But on today's show, we're talking about what it takes for you to qualify for a loan on multifamily property with Michael Becker. That is apartment buildings of 5 or more units, which is a significantly different set of lending standards than what it takes for you to qualify for an investor single-family home, duplex, triplex, or fourplex. Like, yes, you could call a fourplex a multifamily property because multiple families live there, but in the lending world, multifamily begins with 5 or more units in one building. And yes, this is the second episode in that series of 3 straight shows that we're doing on financing. Last week it was 1 to 4 unit property financing. Today it's multifamily 5+. And next week, it will be more of a creative financing show. And did you ever wonder how feasible it is for you and a bunch of buddies to just all come together to buy that 100-unit apartment building that you're always seeing or driving by or thinking about? Well, my guest today, Michael, originates these type of loans all the time. So I'm going to ask him about the feasibility of doing just that. So let's meet Michael Becker. Michael Becker serves as a senior director of Old Capital Lending. He is actively involved in financing commercial real estate and has extensive experience really in all aspects of the transaction process, from underwriting to marketing, financial analysis, due diligence, processing, and closing loans. Michael has closed on multifamily property for borrowers, office, industrial, medical, hospitality, and shopping center transactions throughout the southwestern U.S. Before joining Old Capital, Michael was the top loan producer for 3 consecutive years in his division at Wells Fargo, and he has a lot of experience in the community banking space. Michael's a lifelong resident of North Texas, and Michael's also an avid and a very successful real estate investor himself. He's principal in and syndicated 11 apartment complexes himself. And, on a personal note, I see Michael at real estate investing events, and he's just a very approachable guy. And he increasingly tends to not just be an attendee at these events, but to be a featured speaker. In fact, Michael and I were talking off microphone here, and I just learned that he has been chosen to be part of the faculty on the very prestigious Real Estate Guys Investor Summit at Sea. And to me, Michael's the kind of guy that I like to see representing the real estate investing industry now and in the future. So welcome to Get Rich Education, Michael Becker.
Hey, Keith. Don't know if I can live up to that great introduction, but I appreciate all the kind words.
Okay, well, it's great to have you here. So with originating so many multifamily loans, I think for some people, especially beginning investors, smaller properties from single family homes up to fourplexes are more approachable, but there really are a lot of reasons why someone would want to be in a multifamily property. And by multifamily, we mean 5+ units in a property. Why don't you talk a little bit about the interplay, the advantages and the disadvantages between single-family homes or smaller properties versus apartment buildings?
Sure. And one of the things you didn't mention in my bio, in my background, I actually started out like most people do and invested in single family homes. I ended up actually doing 16 of them before I quit and decided to transition over into doing apartment complexes. And one of the main reasons why I did that, Keith, was just the scalability of it. Every time I did a new single family rent house, it was like I'm buying myself a new job and another headache. So it just wasn't very scalable. So When I finally reached kind of my threshold point, I had enough of it. And whatever happened, I decided that it was time to kind of sell all of them and transition over into apartment complexes. And meaning scalability, usually if you can buy a little bit larger apartment complex, you have the ultimate leverage is what I like to think about it. You can not only have a large enough deal where you can raise money from other people to help you do the deal and kind of syndicate the equity. You can borrow money from your lender. Then you can hire a third-party management company that can then run the property for you and take care of most of the day-to-day activities, and your tenants pay your mortgage back. So it's actually a pretty fully leveraged asset class, really. That's why I really like it quite a bit.
Okay, so rather than having 20 single-family homes, you find efficiencies in the economies of scale of one 20-unit apartment building. There's efficiencies of management. There's only one roof, not 20 roofs. There's only one insurance policy to manage and maintain, not 20, and so on.
That's very true. Yeah, very scalable. The bigger they are, the more efficient they run. The bigger they are, the more revenue they produce. The more and better quality staff you can afford to hire to run the properties, which just makes your life that much easier day to day.
Yeah, I really consider you to be a somewhat rare person because you're both in the multifamily lending side, and yet you're very active as being a borrower, an investor, and a syndicator as well. So you really understand multifamily from so many angles. And with that perspective, I guess lending's a very dynamic field. Really, what have you seen taking place in the multifamily lending industry overall just this past year or so? And is the lending climate becoming more rigid or lax? Or anything else that's really been more recent in the industry, Michael?
Sure. Over the last year, it's generally a little bit more lax, Keith. More lenders are getting into the space, so you having more options on where to go, source your debt. The largest lenders in the space by far is Fannie Mae and Freddie Mac. They're not only the largest lenders in the single family world, they both are the largest, 1 and 2 in the multifamily space. Starting the year out, everything was going like gangbusters in the first part of 2015. And around April, they realized that they were exceeding their government mandated cap at $30 billion in lending each. So coming in about May, they really started tightening up a lot of their waivers where they go away from their standard underwriting guidelines and really try to constrain the amount of lending they were doing. That has worked, and now they've kind of certainly slowed up in the middle part of the year, and it looks like they're about to be on pace to hit about $30 billion each. So that was a little interesting bump in the road in the middle of the year, but overall, the environment is very fertile. There's lots and lots of lenders out there that will do this type of lending, and multifamily still seems to be the darling of the commercial real estate world.
Yeah, it sure has been a popular investment class over the last few years. But now, before we go ahead, I just want to get our listeners straight on the nomenclature. You know, sometimes it confuses people when they learn that when you have an apartment building with 5 units or more, people live there. That's their home. That's their residence. Yet it's not called a residential loan. It's called a commercial loan. Can you clear that up a bit for us?
Sure, and a lot of it's just due to the financing, and like I mentioned, Fannie Mae and Freddie Mac. So the way Fannie Mae and Freddie Mac classify, single family homes are 1 to 4 units, and they don't do 5 units and up unless it's a commercial loan. So that's largely why it is that way, and that is no other good reason, because a duplex is certainly a multifamily home, even though you can get single family financing on it.
Right. Okay. So before we move on with asking about, what it takes for a borrower to qualify, do these multifamily commercial loans for residential property, is what we're going to talk about, does that also apply to office, retail, storage, and other types?
Generally speaking, it does. Multifamily certainly has a couple extra avenues, like the agencies, Freddie and Fannie will loan on multifamily, where they do not loan on industrial or office buildings. Those are typically just go over into the CMBS or commercial mortgage-backed securities market, or life companies, or just your general traditional commercial banks.
I'm an owner of residential apartment buildings myself. I needed to get commercial loans for it. And, I started out in the smaller unit space, fourplexes and smaller. So, I think what you're going to tell us is 1 to 4 unit financing, that is single family home, duplex, triplex, and fourplex, qualifies the borrower when my listener goes to apply for a loan. But why don't you tell us how multifamily lending differs?
Yeah, multifamily and commercial real estate in general, is primarily based on the property, and then the sponsor or the investor secondarily, where, like you mentioned, when you're going to buy a rent house and you're looking to get a loan, it's primarily based off of the individual and their personal financial situation and credit background, and less on the property. So when a lender is looking at the property, they first want to make sure it qualifies, both from an income perspective on an in-place basis. They also look on a go-forward basis on a pro forma basis. So when you guys are going to come in and buy it, if you have a plan in place where you want to go in, upgrade the interior units, do new flooring and new appliances, and raise your rental rates $50 or $100 a month, they will both look at it on an as-is and an as-stabilized basis. So it really is based on the property. And then secondarily, look at the sponsor or the guarantor and his or her financial wherewithal. So how much liquidity you have, like cash, marketable securities, bonds, etc., and what is your net worth, and how is that compared relative to the loan amount? That is generally what they look at, as well as your experience and your track record and your real estate resume. So a lot of these banks, or community banks and commercial banks, generally are okay making loans to first timers. Where if you want to go into the non-recourse environment, which is dominated by Fannie Mae and Freddie Mac on the multifamily side, they don't loan to first timers. They want you to have some level of experience. So you got to kind of start at a community bank or a commercial bank, sign a personal guarantee to the loan, get a little bit of track record, and then you can kind of graduate up into kind of the gold standard loan, which would be a Fannie Mae or Freddie Mac loan.
So Fannie Freddie money, the origin of the money is essentially the same place it is for 1 to 4 unit properties.
Yes, that is correct. Yeah, it's lent by the banks. Fannie Mae and Freddie Mac will issue a guarantee when it is securitized, and then they'll go out and take the loan and sell it on the secondary market and on Wall Street, essentially, and they'll go ahead and a bond trader will buy it and essentially treat it as a bond. So that's how they kind of fund these loans once they're closed.
So just in a summary takeaway here, in qualifying for a multifamily property, which is 5+ units, the underwriter, first of all, looks at the asset, the building. That's the most important thing that they look at. And the difference in 1 to 4 unit financing is that they're looking at the borrower first.
That is very true. Yes.
Yeah, I found it interesting when I got into multifamily apartment buildings first that one qualification they asked for that you need to write a resume for what your qualifications are in going ahead and buying the building, even though they're looking at the building first. And yeah, I didn't really know what to whip up. I just whipped up something off the top of my head, and the underwriter said, "Hey, that was pretty good." So I've really never seen any formality for writing that resume.
So largely what we look at is what we call a schedule of real estate own, or SREO, if you want to use a little bit of jargon. We want to see what kind of experience you have and what you own. And are you buying something that is, you have some experience owning a bunch of 10-unit buildings and you're trying to go buy a 100-unit building? That might be a little bit of a stretch, and the lender certainly wants to take that into account. Or do you own a bunch of 100-unit buildings and you're trying to buy a 120-unit building and the kind of similar size assets? That certainly makes them a little bit more comfortable. One of the main differences, and I kind of want to get out there, and I like to use the analogy that single family is kind of lending is kind of like a science. It's very formulaic. You have certain very rigid guidelines and ways that they go about underwriting. Where on the commercial side, while there's certainly underwriting guidelines, it's a little bit more of an art. I got to paint the picture. I got to, kind of compile. It's like pieces of a puzzle I got to put together and make sure everything kind of fits where it's good enough where the lender gets comfortable with the story, both on the property and the sponsor side, that they're willing to give a loan.
So multifamily lending, that's kind of more of a judgment call on the underwriter's part, where a 1 to 4 unit lending, that's really more of a cut and dry.
Yeah, very formulaic, where there's certainly a little bit more wiggle room on the commercial lending side than there is on the single family lending side. But they certainly do. I don't want to give you the misimpression, but they certainly do have some guidelines. But we do have ways where we can tell a story and mitigate some of the risk to the lender with a good story behind it.
Yeah, just one thing that I learned sort of anecdotally, and just go ahead and debunk this if you don't find it to be true, but the reason that for multifamily financing that they go ahead and look at the building rather than the borrower is that now you're starting to get into buildings and economies of scale and incomes and expenses that are so great that whatever day job the borrower has really isn't that important with being able to pay the mortgage on that building anymore. That's why we have to go ahead and look at the building rather than the borrower.
It's very true. There's very few jobs out there that people have that can afford to pay back a $4 or $5 million loan. So they really are looking at the apartment complex. You're essentially buying a business along with a piece of real estate. It's truly a business that you're operating on, the apartment complex.
That's a good way to think of it. You're sort of buying an operating business along with a piece of real estate when you're getting into these bigger buildings. So I know that there is one metric, even though it's more of an art with multifamily financing, there is one common metric, the debt service coverage ratio, that often an underwriter wants to see that building meet. Tell us about that.
One of the basic core things that most lenders look for is, like you said, a debt service coverage ratio, or DSC ratio. Essentially what that means is what they're looking for is to have the NOI, which is net operating income. And that's essentially just all the revenue the buildings can produce, your rent, your application fees, late fees, et cetera, minus all your operating expenses. So basically every expense less your debt service, that equals NOI, or net operating income. They want that number to be 125% what your P&I payment is, your principal and interest payment is. We refer to that as like a 1.25 debt coverage ratio. That is a very standard industry ratio. Sometimes you'll have a lender that'll do like a 120 debt coverage ratio, but typically a 1.25 ratio is kind of the minimum that most lenders are looking for.
Just to make it straightforward for the audience, so a DCR, a debt coverage ratio, you sometimes see the acronym DSC as well, debt service coverage. They both refer to the same thing. So let's talk about liquidity a little bit. When the borrower comes, what kind of liquidity do they need to have as far as, number one, the percent down payment, and number two, the post-closing reserves that they need to show, Michael?
I'll kind of break it down into two avenues. Most community banks and commercial banks don't have a hard, fast rule. So this is kind of a rule of thumb that I like to use. Typically, they want the guarantor or guarantor pool, if there's multiple guarantors, to have a net worth equal to or greater than the loan amount. So if you have $1 million loan, they want collectively to have a net worth of about $1 million. And they want post-closing liquidity. So after the down payment, they want you to have 20 to 25% of the loan amount minimum. Like I said, that's generally not a hard, fast rule at most of these banks, but that's kind of the rule of thumb that works. If we transition over into the Fannie Mae or Freddie Mac lending, their guidelines are net worth is the same, equal to or greater than loan amount, and they want post-closing liquidity of 10% or greater of the loan amount. Some of the big differences between a Fannie Mae and just a regular community bank loan. Typically, the community bank loans don't do impounds or escrow for taxes, insurance, or replacement reserves. While on the Fannie Mae side, they escrow for all those things. So it's really like a permanent loan. They're going to make you on a monthly basis escrow for, like I said, taxes, insurance, and replacement reserves. So typically, they'll figure some formula depending on the age and condition of the building, somewhere around $300 a unit a year in replacement reserves, and they're going to make you put 1/12 of that away every month. So they know that you have some money set aside as like a forced savings account that you can come in and help pay for you the things that wear out in these buildings as you own it over the next 7 or 10 years.
So you're talking about as a borrower, when they make their monthly PITI payment into escrow, they're also making some sort of replacement reserve payment that goes off into a side fund that's escrowed between both the borrower and that lender in case something comes up.
When something comes up, because there's always something coming up when you own these deals.
Yeah, you got that right. So now, what about borrower credit scores for multifamily property? Does it matter at all?
Yeah, it does matter. Most of the banks don't have, or if they do have a hard, fast minimum, it kind of varies. Typically, if you're 640 or higher, that usually works. But if you start having, collection items or tax liens or a bunch of late pays, you better have a pretty good answer because they're going to pull your credit and they'll start asking you about it. One of the other things most lenders will do as well is do some level of like a background check or what they call a UCC search. And then what they'll do is they basically just kind of run a background check on you. And if you have any sort of like pending lawsuits or judgments or anything in your past, it generally comes up. So you better have a pretty good explanation if you have something like that in your background.
Great answer. You're listening to Get Rich Education. Our featured guest is Old Capital Lending's Michael Becker. More when we come back. I'm your host, Keith Weinhold. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education with our guest, Old Capital Lending's Michael Becker. Michael, what about loan duration? I think a lot of people are used to doing 30-year fixed amortizing loans for 1 to 4 unit properties. Why don't you tell us a little bit about the duration of loans, balloons, and prepayment penalties?
Sure. Yeah. Like you alluded to, Most single family homes are you typically done on a 15-year or 30-year fully amortizing loan. In the commercial world, that just isn't very readily available. Most community banks loan money in 3 or 5 or potentially 7-year increments, where they have a maturity or a balloon note is what it's referred to, where the balance would due at the end. And they'll amortize them anywhere from 15 to 25 years is pretty typical, with 20 or more likely 25-year amortizations being very commonplace. A lot of times you can get 1 year, maybe a little bit more, but typically 1 year's worth of interest only on the front end before it converts over into an amortizing basis. On the agency side, the Freddie and Fannie side, they typically, or you can get either a 5, 7, 10, or 12-year fixed rate loan. They also have a couple of variable options, but most of them are typically done on a 10 or 12-year fixed rate loan with a 30-year amortization. Again, you can also typically get 1 year, sometimes up to 3 years worth of interest only on the front end. So it's not like a single family loan where you get 30 years fully amortizing. But in my experience owning both rent houses and commercial buildings like apartment complexes, my mentor when growing up gave me the analogy, which I still use today, like owning apartments, you kind of own them in dog years. So every year ownership, so it really feels like 7. So usually after 4 or 5 years, you're kind of ready to do something different anyways, because you feel like you've been in it for a long, long time.
Right. Yep. That dog feels old too soon. So typical scenario might be that in this case, for a multifamily building, a larger building, somewhere gets a loan that I might call a 5-year balloon loan with a 25-year amortization. A 5-year balloon, meaning that entire note amount comes due in 5 years, and the 25-year fixed amortization, meaning that your loan payments, rather than being stretched out 30 years like they might be with a 1 to 4 unit property, since they're only stretched out 25, that makes the payment a little bit higher than it would on a 30-year loan. You want to tell us a little bit more about this example I'm giving you, the 5-year balloon with a 25-year fixed amortization and prepayment penalties within that first 5 years and how that typically looks?
Yeah, so most of the banks, if you get a 5-year loan and it's a community bank loan, they typically have what they refer to as like a step down prepay. So it's a 5-year loan. So you have 5-year maturity, like he said, you have a 25-year amortization. So your payments are based on as if it was a 25-year loan. If you are in the deal, and most of them typically have, like I said, a step down prepayment penalty on a 5-year loan. It's typically like a 3, 2, 1, 0 step down prepayment penalty, where it'd be like 3% year 1, 2% year 2, 1% year 3, and then you could prepay without penalty in year 4 or 5. If you go over into the agency world and you have a 10-year fixed rate, they typically put in what is called a yield maintenance prepayment penalty. Or if you go into a CMBS loan or commercial mortgage-backed security, they call it a defeasance penalty. It acts very similar to each other, where it's like a formula or an algorithm where they, basically determine what the note rate is, how does that compare to what the current market rates are if you paid it off, and then how much time is left on the loan. So if you're going out and getting a $3 million loan, and you try to pay it off with, say, 8 years left on the term, I mean, you could look at a pretty healthy prepayment penalty, sometimes upwards of $500,000, $600,000, $700,000. So relative to the principal balance is pretty a large amount of money. One of the good things, and one of the good attributes about the agency loans that I haven't mentioned today, most of those loans are assumable. So if you are going to be able to, you want to sell your property, the next guy can come in and assume your mortgage and just kind of take it over, where most of the commercial banks, or if you were to do like a 1 to 4 single family home loan with Fannie Mae or Freddie Mac, those loans are non-assumable. So if you want to sell the property, you have to pay the mortgage off. There's some qualifications that the next guy has to come in and meet to be able to assume your loan, but it does allow a little bit better flexibility when you're trying to sell the deal without having to pay a very large prepayment penalty.
Okay, so just to drop back and make clear on the balloon loan and the prepayment penalty, a balloon loan means if you get a 5-year balloon at a 25-year fixed amortization, at 5 years, the entire loan amount is due. And at that point, you can either sell, refinance, or pay it off. With the 3-2-1-0-0 graduation you described, if you'd pay that off in year 2, you'd have a 2% penalty. So that means if you had a $3 million loan and you paid it off in year 2 with that 2% prepayment penalty, you would owe a $60,000 penalty. Is that right?
That is right.
Okay. Now, why don't we talk a little bit about recourse versus non-recourse loans? This is a source of constant questions.
Yeah, so recourse loans typically are done. Most of the community banks or commercial banks you go to, they generally want you to have full recourse, meaning that you typically would form an LLC or a corporation or some entity, some form when you're buying a apartment complex or commercial building. That would be the owner of the real estate and the borrower of the loan. And then they would want someone to stand behind and sign a personal guarantee. So essentially what it means is if there's an issue and the property is not producing sufficient revenue to be able to pay its mortgage back, and there's a default situation, the lender likely would foreclose on you, sell it. And if there's a deficiency, they have a $3 million outstanding loan, but can only sell the building for $2.5 million. They can then go after the guarantors for the deficiency of $500,000 and try to collect it. Or in a non-recourse environment, which is what Fannie Mae, Freddie Mac, and CMBS and life loans typically are, it's non-recourse, but they do have recourse to the property. They just don't have a recourse to any individual. Most of those types of loans require someone to sign on what Fannie Mae calls a key principal, or they make you sign what is commonly referred to as a bad boy carve out. So you can Google bad boy carve out and you look all the things that means. But in layman's terms, what a bad boy carve out means is that is a non-recourse loan. But if you commit some level of fraud or misrepresentation, they can spring in a guarantee to the people who signed on as a KP or key principal. So an example of that would be that if you, in Texas, we get hailstorms here. So you had a big hailstorm, get an insurance claim, and you don't tell your lender, you just take that money into Vegas. That would be a bad boy act, and they could potentially spring in a guarantee.
No, that's a really key distinction to make. So, I think sometimes some aspirational people that want to think big, which I really appreciate, and I actually reinforce that let's thrive mentality here, they often think, gosh, what would it take for me to buddy up with some of my friends and go buy that big apartment building complex, all of us together? What do you have to say about that? How feasible is that, Michael?
That's very feasible. Virtually every loan that I do, Keith, is some level. We call it a syndication. So that's essentially a syndication where you have multiple people pooling their money together because they can't afford a 100-unit apartment complex on their own, but they get 10 of their friends together, friends and family together. They can certainly pool their resources and qualify for the loan and have enough capital to actually make the down payment. So that is very, very common in this world. Virtually every deal I do is a syndication. I know you have spoken with Russell Gray of the Real Estate Guys in the past, and Ken McElroy as well, when Ken McElroy was a very prolific real estate syndicator. So I would certainly refer people back to those episodes to listen a little bit more about it. But one thing I would certainly say is to make sure that's something you don't want to mess with doing amateur hour, and make sure you hire yourself an attorney, specifically a securities attorney that can help you prepare a private placement memorandum, or what is referred to as a PPM, to make sure you dot your I's and cross your T's and don't get into trouble with the Securities Exchange Commission, because that is one place I certainly know I don't want to be in.
Right. A lot of times if buddies want to come together to buy a building, they might recognize something that's somewhat distressed. And one symptom of distress is that property might only be, say, 50% occupied, meaning that it's 50% vacant. I mean, how feasible is it to get financing for a property in that condition?
Yeah, they're certainly very doable. When the more distressed level, either both physically or economically, and usually when there's economic distress in a property, there's certainly some physical distress as well. The more conservative the lender is going to be in their financing terms. So if I could typically give you a 75 to 80% loan to value or loan to cost on a stabilized property, they're going to start ratcheting that down, Keith, or maybe make you have some additional collateral. So I would expect, 50, 60, maybe 65% loan to cost versus say 75 or 80, and then potentially even having some level of a cash pledge until you meet some hurdles along the way where you hit a certain occupancy number or a certain debt coverage ratio number, and then they might release that additional collateral back to you. But it is very doable. Fortunately, where I live and most places across the country, the environment that we are in the second part of 2015, there's really not that much distress left in the market today.
Right.
But, that's not going to say, there will be another cycle, and that will be something that will come back around at some point.
Yeah, there's always opportunity, but those opportunities sure are drying up as we're here at the end of 2015. Now, one really important thing to find out about, Michael, is people typically don't live in the part of the country where the best deals are. So with multifamily property, how feasible is it for someone to live in one state and get a loan in another state?
Happens all the time. It certainly is an additional headwind that you will face when you're looking to buy a deal. In particular, if you're inexperienced and it's your first deal, a lot of the community banks don't like out-of-staters. Certainly first timers. So we can get deals done. It might be, again, a scenario where we might have to ratchet down the leverage a little bit to get your first deal done. I live in Dallas, Texas. We have a lot of people that come here from California. So usually when they get their first one done, they build a presence here, it becomes a lot easier because they have a little bit more ties to the local community. With Fannie Mae and Freddie Mac, if you're graduated to that point, it doesn't really matter that much at all. That happens all the time where people from out of state buy, in other markets, and it's a very, very commonplace in that world. But again, I want to stress those loans are typically reserved for people with multifamily experience, so you're not learning on their nickel at the same time.
Hey, I guess just as we're winding down here, I think one more thing I want to touch on is, what about the closing costs? When a borrower comes to the closing table, how do these multifamily 5+ unit closing costs compare to 1 to 4 unit residential? What does one need to think about there?
So we have a few extra reports that you probably would have to get with a commercial loan than you generally do with a 1 to 4 loan. Typically with a 1 to 4, all they typically do is an appraisal is all your lender's going to require. On a commercial loan, you typically have to pay for an appraisal, a phase 1, which is a environmental study to make sure there's no contamination in the groundwater or the soil, and then a property condition report as well that the lender orders in addition to anything that you want to do on your own. So those are typically 3 reports, plus most of the lenders have their lender counsel that you have to pay for as well. So I can add several $1,000s onto it. So it's not a cheap game to get into. So you don't want to just kind of apply for a bunch of loans willy-nilly that you're not intending on getting. But certainly on most apartment complexes north of $1 million, you're probably talking somewhere in the neighborhood of $20,000 for an appraisal, a phase 1, a property condition report, and lender's legal. Say $15,000 to $20,000 is probably a typical range to get a loan of that size or greater. So, the larger the loan, the larger the property you buy, the smaller on a percentage basis that is. In addition, most of these loans have a 1% origination fee to them as well that you need to tack on to that.
Okay, so there can be some significant upfront costs here, especially if that's coupled with a prepayment penalty loan. So this is, something that you want to commit to over the longer term, maybe even longer than owning a single family home, duplex, triplex, or fourplex.
You're generally talking about larger dollar amounts. So as a percentage, it's probably not that much greater than on a single family 1 to 4. You're typically only borrowing on a rent house, probably, $150,000, $200,000 typically is kind of probably a high end for a rent house, where here you could be borrowing in the millions of dollar range.
All right. Well, is there really anything else in general, Michael, that you think our listeners ought to know about multifamily investing?
Yeah, one of the things that I think is very important is certainly to get yourself educated. There's multiple resources in most big cities have certain different RIAs, real estate investing clubs. A lot of them have a multifamily focus. I think if you kind of search online, there's certainly quite a bit of education that you can look to seek to have. So make sure you get yourself educated, because you're talking generally bigger dollar amounts when you're talking about apartment complexes or commercial buildings. So spending a few $100 on some education can save you thousands of dollars or tens of thousands of dollars worth of mistakes down the road. So I would certainly encourage everyone to get educated, make sure you understand what you're getting yourself into. Also, the other thing I want to make sure I stress is, real estate investing is kind of a team sport in a lot of ways. So myself, the role I serve as a commercial mortgage broker, we are, one of your team members along with an inspector, a property management company, your lawyer. So certainly, having a good, confident commercial mortgage broker on your team, helping you size up a deal and telling you what a realistic loan would look like for that property certainly can help you shortcut and eliminate a lot of time and mistakes. If what you're thinking about is unrealistic and they can tell you that early on, it will certainly save you a lot of time.
Know your market and build your team. Now, your company, Old Capital, how many states do you originate loans in, Michael?
So we can originate across the United States. We are based in Dallas, Texas. So most of the lending we do is in the Southwest and specifically Texas, but I have done loans in Florida and multiple other states across the country. So we do lend nationally. If it is a little smaller deal and it's your first time and it's a community bank loan, it's going to be a little harder for us because I don't know every community bank all across the country. So usually I typically give someone some advice and then recommend they find someone in their local market that, kind of looks like this or looks like that to kind of help them, give them a nice little push if I can't do it myself.
I found you to be such a good resource. Why don't you let my listeners know how they can find out more about Old Capital and more about you?
Sure. Yeah, I'll refer everyone to two different websites. So first one is oldcapitallending.com. That's oldcapitallending.com. That is where you can find us. And if you have any questions about commercial lending, you certainly look at our contact information on there. The other one is where I do my real estate syndicating, and that is under spiadvisory.com. That's spiadvisory.com. You can find a bio, a little bit more information about me there as well.
All right. So that's, again, oldcapitallending.com and spiadvisory.com.
Yes, sir.
All right. I've looked up Old Capital Lending in the past myself for my own financing needs, and I was always well taken care of over there. Michael Becker, thank you so much for coming on to Get Rich Education and providing great value today.
Hey, Keith, I appreciate everything.
All right. Well, as compared to a single-family property, multifamily apartment buildings have their share of advantages and disadvantages. I'll probably do an entire show sometime in comparing the two asset types, single-family versus multifamily. But just real quickly and in general here, single-family home advantages are a lower purchase price, so it's easier for you to get in, greater liquidity as they're easier for you to sell on your exit. They're often in a better location. With a single-family home, you typically have a better quality tenant and you have less tenant turnover than you would in multifamily property. Multifamily advantages are better scalability, a lower management cost, fewer vacancy expenses. You're going to get a better cash flow per invested dollar, and you have greater control over that asset's value. So, well, hey, special thanks today to Old Capital Lending's Michael Becker. And one more thing I'd be remiss if I didn't mention to you is if you want an opportunity, genuine, specific, actionable opportunity so you can start creating long-term wealth through cash flowing property with a relatively low startup cost for you, if you want private buying opportunities for turnkey properties in the best U.S. markets, opportunities that are not available to the general public, and you'd like the opportunity to get the links so that they're sent to you so you can watch a webinar to consider that opportunity, what you can do is subscribe to our free newsletter at getricheducation.com. That's how those opportunities come to you right in your inbox. And in the webinar format, you can ask real-time questions if you choose to. So again, subscribe to our free wealth building newsletter for those opportunities and more at getricheducation.com. Well, I'm signing off from the capital of Arkansas here in the heart of Little Rock. I'm your host, Keith Weinhold. Thank you so much for joining me. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.